Hello and welcome to another edition of the Market Technicians Association podcast series. Today, Jeanette Young, CMT, will have the opportunity to interview Sam Stovall. As Chief Investment Strategist of our Equity Research Group, Sam Stovall serves as analyst, publisher, and communicator of S&P's outlooks for the economy, market, sectors, and stocks. He is the chairman of the S&P Investment Policy Committee, where he focuses on market history and valuations, as well as sector and industry momentum strategies. Sam is the author of The 7 Rules of Wall Street, which was published in February 2009, as well as Standard & Poor's Guide to Sector Investing. He also writes a weekly investment piece, Stovall Sector Watch, on www.advisorinsight.com, which focuses on market sector history as well as sector industry momentum. Sam joined Standard & Poor's in April 1989. Prior to S&P, he served as editor-in-chief at Argus Research, an independent investment research firm in New York City. Sam received an MBA in finance from New York University and a BA in history education from Muhlenberg College in Allentown, Pennsylvania. He is also a certified financial planner.
Today's podcast is with Sam Stovall, and we're very, very fortunate to have him today, and I'm very happy to be hosting with him. My name is Jeanette Young. I am the director of the CMT program here at the Market Technicians Association. Hi, Sam. How are you doing today?
I'm doing well, Jeanette. Thanks for inviting me.
Oh, thanks for coming. Well, we're going to get right off into this conversation, and we're going to talk about a few things, let's say recession, and V-bottoms, which may not be V-bottoms, which may be U-bottoms, and cash for clunkers and stuff like that. Where do you want to start?
Well, we could sort of start right at the top and say, do we think that this market is headed for some sort of a correction or whatever? I think that's what tends to be on most people's minds these days.
And do you think that kind of thought process is what's keeping the market aloft?
I think so. Typically what happens after bear market bottoms is we get a nice little advance, and usually it comes in about 40 days. So I call it a Moses movement because it comes in 40 days. We get a very sharp advance, typically retracing about a third of what we lost in the prior bear market. But then we go through a digestion of these gains, what technicians would call a retest of the prior low. And for all bear markets going back to 1932, the average price decline is about 9%. But following mega meltdowns or bear markets of 40% or more, which we had in the 29 through 32 period, 1938, 42, 74, and 2002, the median correction off of that initial rally has been a decline of 14%, or twice what we have received in the mid-June to mid-July period. So I think a lot of people are on the sidelines now, still a lot of cash out there, just waiting for this correction to ensue before they jump back in. And because of that, I sort of wonder if the correction is going to come a lot later than most people expect. And in fact, we end up going through what I call a mini melt up just prior to that correction.
So what you're seeing is that the cash is running in, chasing the market not to have missed it, as well as portfolio managers, and that has been keeping this retreat or any kind of pullback that we've seen extremely shallow. So, but with that same consideration, wouldn't we consider that once that money has been invested and it's no longer short covering, and I don't think it's short covering anymore at this point, I really think it's true investors running back in, once that's exhausted, are you talking about a vacuum?
Well, I think once that initial push of money going into the market has been exhausted, then I think we probably could go through a deeper correction than we saw with that 7% midsummer decline. But I think investors might be surprised with the resiliency and the strength of this upward move. Our chief technician, Mark Arbiter, who is also a CMT, he thinks that because we broke above the 1020 resistance level, that he believes that we could be now moving our way up to as much as 1,200 on the S&P 500, because he just doesn't see much resistance between that 1020 and 1,200 level.
Yeah, I
The
would
work.
agree with him on that. I looked at the market profile charts on it, and he's truly correct. There is no overhead supply. It's like vacant. It's empty up there. So I can see his comment regarding a melt up. When I did melt the monthly charts, however, on the S&P 500, I did notice that we are kind of at the 50% retracement number. So we might have a reason to kind of hang on here and back and fill a little. And of course, we're in September, October.
Right. Well, September is certainly the worst month by far of all the 12 months, whether you go back to 1990, 1970, 1945, or 1929. The S&P 500 has posted its worst average price performances in September, average price decline of 1.3% since 1929 versus an average increase of 0.54% for all months, and the frequency with which the market declines is the highest at 56% going back to 1929. And again, you get negative numbers no matter which of these time periods you look at. So if history repeats itself, and we all know that there's no guarantee that it will, I think September is a good reason for investors to believe that it'll happen in the coming month rather than in some period a little more down the road.
Well, that brings me to your book, which is really a good read, a nice, quick read, very handy, very, very compact. And you do talk about some defensive strategies. You want to speak about that?
Yeah, the 7 rules of Wall Street, they are rules of thumb or old sayings that you can use to build portfolios that beat the market. And the reason why I wrote this book is because I basically got the best bit of investment advice from the least likely of sources, and that was Clint Eastwood. When he was playing Dirty Harry in the movie Magnum Force, he kept saying that a man's got to know his limitations. And knowing
that was right in there. And as a futures trader, I believe in capital preservation because without your capital, you can't trade tomorrow.
Well, that's true. And I also find that I can be my own worst enemy because I can allow my emotions to get the better of me. So with these 7 rules, basically what I'm doing is pretending that I'm working for George Steinbrenner, who says, don't think, just do what I tell you, and doing back testing to 1970 using industry data within the S&P 500 and back to 1990 using sector-level data within the S&P 500. The 7 rules that I looked at were let your winners ride but cut your losers short, as goes January, so goes the year, sell in May and then go away. Who says there's no free lunch on Wall Street? There's always a bull market someplace. Don't get mad, get even. And then finally, don't fight the Fed. But you brought up the question about being a little bit more defensive at this point. A lot of investors say, gee, Sam, the market has gone up so strongly. I'm worried about putting money to work today. Maybe I should be, if I do, I should be focusing on the defensive areas of the market, like consumer staples, healthcare, utilities, because as we all know, when the going gets tough, the tough go eating, smoking, and drinking. Now, with us being in the beginning of a new bull market, maybe we really should be in the more cyclical areas of the market. So maybe I should be investing in the poster child of cyclicality being technology because the market tends to do so well right after a bear market bottom. And my answer is, if you're confused, go to lunch. And that's the free lunch portfolio, which basically says that if you invested in 50% consumer staples and 50% technology, because they both have such low correlations with one another, then you actually would have gotten a free lunch because the portfolio's 9.0% compound rate of growth beat that for technology's rate of growth of 8.3%, which was the highest of all 10 sectors over the past 20 years. But your standard deviation or risk would have gone down substantially from the 35 that you saw in technology, which looked more like an EKG diagram than anything, down to about 21 or just a shade above the market itself. So by having 50% staples, 50% tech, you get a return that's not only better than tech, but also better than the market, and the risk-adjusted return ended up being substantially better for this portfolio than for either tech or the market. Maybe these returns are a little bit too hard to swallow, but I do have the back-testing data in the book.
Great returns. And that goes into, that follows your most recent piece that I read on the 17th that you put out. It was also very interesting regarding that, too. Global Equity Strategy, U.S. Sector Watch.
True. Well, it's on that same topic. But also I had written an article saying that you don't want to sell in May and then go away following bear market bottoms. I showed that in that 6-month period from the end of April through the end of October, even though the market typically sort of treads water in that summertime period, following bear market bottoms, the S&P has gained an average of about 12% and has declined only once in those 14 observations. It was flat in one additional time, so we were up a good 12 of 14 times. So investors definitely should be in stocks.
So going into September, which is the worst month of the year to be invested in, but because we were up in January, we should not abandon positions at this point, but perhaps continue and put on your risk-adjusted portfolio, your free lunch portfolio for the listeners out there. Would that be something you would agree to?
Well, I think that the free lunch portfolio, in which you have 50% tech, 50% staples, has been a fairly consistent outperformer, beating the market basically about 2 out of every 3 years and beating the market by about 300 basis points per year. Of course, as we all know, past performance is no guarantee of future results, so there's no guarantee that it will continue to advance.
There is no guarantee. But
right.
Sitting in cash is no great guarantee either of anything but having not much more than you had when you began.
Exactly. Well, I have to say that just so people don't think that it's always going to work out this way. And because the market fell 8.6% in January of this year, the January barometer actually points to another challenging year. Going back to World War II, what I have found is that if the market is up in January, it continues to rise 85% of the time in the remaining 11 months of the year, with the average price change being about 12% in that 11-month period. Following a decline in January, however, and I think January is a good barometer of full-year market performance because I think investors are a lot like dieters. They look to January as a new beginning, and if they're pretty sanguine about investment opportunities in January, then chances are the full year's performance might not be great. And going back to 45, the average price change has been a decline of more than 2% whenever we have had a down January. It's not perfect because it does not anticipate bear market bottoms as we have seen so far this year.
Also, we have to comment about the fact that in this recent bear market, we're in a global market and an electronic market, and things happen a darn sight faster than they ever did before. When I started as a baby broker, I mean, there was always a 20-minute lag. I mean, you get some news, 20 minutes is free lunch for you. But now it's like instantaneous zap all over the globe.
Absolutely, and as a result of that, we all know that fear and greed are the primary emotional motivators for investing, but in this day and age of instant information, I can experience both fear and greed at the exact same moment.
Yeah. So we have 2 more things I'd just like to talk about. We're heavily into the back-to-school season right now, where mommies and daddies are out there shopping for the kids' school stuff, and I'm of the opinion that parents will never cut back on their children too much, and they would rather do without themselves and let their children go to school looking okay and showing the rest of the neighbors that they're fine. Do you think that the cash for clunkers has stolen some of this buying power away from the average American?
Well, I think that certainly is the possibility. Our economics team believes that cash for clunkers has not increased the number of cars that would have been purchased, but simply accelerated when these cars would have been traded in. So as a result, they are forecasting that the 300,000 cars that were traded in because of this Cash for Clunkers program probably ended up being stolen from future years. So about half of that they are then taking out of their 2010 forecast, and then the remaining half in 2011 and beyond.
About the car companies putting workers back on because the demand is so heavy?
Well, I mean, but that's a good thing, and that's certainly one reason why we have reduced our unemployment peak from about 10.6% to about 10.3% and reduced the overall time frame in which we remain above the 10% level. But again, it could end up being just a short-term pop for a lot of these automobile retailers as well as some of the manufacturers. While we
I would agree. I certainly agree with you. I think that they're anticipating a little too much without a little concern about the buying power of these Americans who have pulled back their horns literally and tried to get their debt under control. I mean, So it is a short-lived growth process, but the final demand, when that kicks in, who knows where that is?
Right. And you also brought up back to school. Specifically, the media likes to describe back to school as being a make or break selling season. But our analysts are saying, no, it really is more like another calendar event similar to Valentine's Day or Columbus Day, because people end up buying clothing and whatnot all year long. They don't just wait until the end of the summer in order to do this.
So what about Christmas?
But you're bringing up a good point that it ends up being a good barometer for the holiday period, which is much more important for retailers. So it gives us an idea, sort of allows us to have our fingers on the pulse as to what we might expect for the holiday season. But in general, our belief is that we're likely to see weaker back-to-school sales. We think that spending will be down anywhere from 5 to 8% as compared with what we saw in 2008. And let's face it, also 2008, we saw that spending was flat to down 5% on a year-over-year basis, depending on the source, product categories, or time frame that you look at.
And the Cash for Clunkers, of course, is put money in, but this is taking it out. So what do you see for Christmas?
Well, I keep telling people what I want, but there's no guarantee I'm going to get it. Our expectation is that we probably, again, will see a decline, single-digit decline over the holiday period as compared with 2008, which also was down from 2007. So with a lot of consumers, even though they're feeling a little bit better, as we saw today with the consumer confidence number jumping up a bit more strongly than had been anticipated, the unemployment level we still think is likely to peak out above 10%, which could end up being a bit of a damper to consumers' mindset in the next several months.
Do you think that the consumer confidence number is up because the stock market has been doing so well lately, or that they think or perceive that there is some stability in the housing market, which I don't agree with, but they may perceive as?
Yes to both. I think there are an awful lot of factors that go into consumer confidence. First off, there's an old saying that if it bleeds, it leads. So if there's usually negative information, then that's what's going to be flashing up on radio, on TV, on the web to get Main Street viewers' attention. But at the same time, if we've already gone through a couple of years of negative news, then in a sense, whatever positive news there might be is now noteworthy, and that's what ends up being flashed. So I think people on Main Street are being encouraged by what they're seeing on Wall Street. They're also being encouraged by at least what they're reading in the paper about a turnaround in housing, a turnaround in potentially in the job markets, that green shoots are now turning into young saplings. So whatever you say, whether it ends up being a lowercase V-shaped recovery, whether it ends up being an elongated U recovery, or even a W recovery, I think it's a little bit too early to tell. And so at least in the near term, a lot of consumers are feeling better.
At least we see V is out. Okay, joking. All right. Why don't you comment briefly on the case for Bernanke. I understand he's going to be renominated. And today, I don't know whether you saw, Stephen Roach came out with not a scathing report, but it's certainly negative of the case against Bernanke. How do you feel about it?
Well, my feeling is that he is certainly one of the most renowned students of the Great Depression, and so I think that because of his knowledge of the things that we did wrong back in the 1930s, probably helped us to avoid a repeat of the 1930s this time around. Certainly, a lot of the cynics will say, yeah, he didn't make those mistakes, but he made other mistakes. I keep putting myself in the position and say, well, could I have done a better job? No. Do I know of anybody else who could have done a better job? No. And so as a result, I'm fairly happy with Bernanke's performance, and I'm glad that he was there when he was. Also, the thought being that we want to make sure that we don't remove the stimulus too quickly and have a similar situation to the fall of 1938, as well as have a similar situation to what we saw in Japan in the late 1990s. So again, these are periods that are well known to the President Fed Chairman, and so my belief is that he probably is also well prepared to handling the removal of stimulus, which is what we're going to need to take place to try to avoid a dramatic pickup in inflation.
Yeah, and when we look at Treasury market or the real yield or even the Baltic Dry Index, it does not look that we're near the removal of that stimulus at this time or any time in the near future. It doesn't look like he can do that right now, or the market's telling us he can't.
Right, and our belief is that he probably won't be removing that stimulus for a while. I think that most central bankers feel comfortable fighting inflation but have a hard time fighting deflation. And I also think that they believe that because unemployment will probably average above 10% for all of 2010, plus capacity utilization being as low as it is, we've got a couple of years of stimulus available to us before we start to see the adverse effects on inflation.
Very, very good way to sum it up. So it's been a pleasure speaking with you. And summing up, I would say that you're looking for a W or a U bottom, some kind of stability, not too much to look forward to as far as green shoots and full-grown plants. But with your defensive strategies, I think you can be a winner on Wall Street. And I'm recommending that everybody read the book, 7 Rules of Wall Street by Sam Stovall. Sam, any closing comment?
Just, Jeanette, that I'm very happy to have been invited to do this podcast, and I hope you invite me back.
I absolutely will. Have a very, very nice day, and thank you again.
Thanks. Bye.